Welcome to the first episode of ADFIAP's Dev Talks pilot series. For this episode, we will be covering the topic Understanding Development Banking. Did you ever wonder what sets a development bank from other banks and financial institutions? It's the word development attached to it. But of course, there's more, and we will take a closer look about its difference by answering some questions.
What does a development bank do? It focuses on economic development, while banks mobilize and allocate money by taking deposits and giving loans. Why are development banks created? For the welfare of society, while banks make profits and dividends for shareholders. Where do development banks serve? To unserved or underserved priority and strategic sectors of the country's economy, while banks to sectors which can afford to pay the cost of money. And to help you understand further, consider this. Banks are usually privately owned, created under a corporation law. They are transaction-based and generally provide debt rather than equity. Development banks, however, are usually government-owned, created under a charter, project-based, and can provide both debt and equity plus technical assistance.
How about development banking? What does it mean? Development banking is providing access to financial and support services for the underserved and unserved strategic and priority areas of a country, in order to achieve sustainable growth of the economy and thereby assure a more equitable distribution of the benefits of progress and a better quality of life for its people. How did development banks evolve over the years? Development banks started in 1822 in the Netherlands. It grew in the 1950s when the World Bank initiated Development Finance Companies, or DFCs. 1990s was a decade of transformation, and at present, the four models were established, namely policy, special purpose, universal, and ComDev. What needs do development banks fill? The need for a special purpose institution. The need to provide financing to the engines of growth, to support national priorities of long-term investment in the real sectors, and lastly, in case of market failure, requiring national governments to intervene in the financial markets. What are the roles of a development bank? As initiator, as an institution builder, as a catalyst, as development advocate, and lastly, as the bank of last resort. What are the development banking models? Policy development banks directly support the national government's economic policy plans and directions. Special purpose development banks support focused sectors of the economy. For example, SME Bank, Agricultural Bank, Housing Bank. Multi-purpose development banks, also called universal banks, support both development projects as well as commercial businesses. While the commercially oriented development banks support development through commercial banking services.
What did you learn from this video? The difference between development banks with other banks. The needs supported by development banks, its roles, and 4 development banking models. We hope you enjoyed learning about development banks. Join us again next time for more information on development banking and finance industry and profession, here on ADFIAP Dev Talks.